So Donald Trump has delayed the reciprocal tariffs, and Elon Musk is starting his own party. We're going to talk a little bit about those things, maybe some MicroStrategy and Schlumberger today on Open Interest. Hello everybody and welcome. I'm Mike Ho. Welcome to Open Mic, Fairfield County, Connecticut, sweltering hot, humid edition. You can probably see that I am not in my familiar office on the West Coast. I'm in a location where it's about 20 degrees warmer and about 80 humidity points higher, it would seem. We do have the air conditioning going. You might be able to hear it in the background, but it seems to be struggling to keep up a little bit. So that's why I'm sporting, I was going to say a golf shirt, but as you can see it says tennis spin on it, so I guess this is actually a tennis shirt. The former proprietor of the Brad Gilbert Tennis Store in Marin County, California, has a YouTube channel of his own called Tennis Spin, which if you have any interest in that sort of thing, I encourage you to go and check that out. Okay, so first thing I wanted to talk about a little bit before I get to your questions, and it looks like a couple of the questions we have are related, and they seem to be related to MicroStrategy preferreds, and I think the questions are good ones, to be honest, so they deserve some time and attention. First thing I wanted us to take a look at was Schlumberger, actually. So Schlumberger, as most of you will probably know, it's the largest oil services company. Many of you may also know that I got my start trading the oil service index, among other things, on the Philadelphia Stock Exchange in the late 1990s, before the advent of ETFs. So at that time, if people wanted to have exposure to a sector, one of the ways that they would do that was with cash-settled index options that were traded on the Philadelphia Stock Exchange. They had them on the semiconductor index, the bank index, and the oil services index. We also made markets in a lot of the oil service index stocks, including Schlumberger, including Halliburton, including then Camco and Cooper Cameron. I was down there when the Camco takeover actually took place, and basically what you would do is you would buy options very similar to those on SPX, so they were a cash settled option, and then we would trade the baskets of the underlying stock. And I also spent some time on the New York Mercantile Exchange trading oil and gas. So it's an area, it's an industry and a sector that's near and dear to me, and I just happened to notice that Schlumberger really has not been performing well this year, something that some of you may have observed. In fact, it really hasn't been performing very well since the fourth quarter of 2023. 2023 is when it reached its highs, and it's basically been in a downtrend ever since. However, I am interested in whether or not most of that damage may already have been done. So like most companies in the oil and gas space, whether they're upstream or downstream, tend to ride the tide of oil prices. When oil prices are high, you are likely to see more investment in exploration and production, and of course, who services that? But the oil services companies. Now, Schlumberger has less exposure to North America than, say, Halliburton does. But it is a company that, like I said, it's been really moribund now for a couple of years, and I thought we might take a look at a couple metrics. So on my screen right now, I have a chart. The lower chart here is Schlumberger, and so I just drew a line over here so we can see basically where the stock price is relative to its history. And up here, because as I pointed out, oil obviously is an important element when we're thinking about these companies, is on this chart here. But if we take a look, so this chart, which is more of a fundamental valuation chart, this is a chart of enterprise value to EBITDA, earnings before interest, taxes, depreciation, and amortization. Now, I will say that I don't know that EBITDA is sometimes used, and this is best EBITDA. What best EBITDA is basically the average of sell-side analyst estimates of forward earnings before interest, taxes, depreciation, and amortization. Is EBITDA, which is sometimes used interchangeably as like a crude form of free cash flow analysis, is that a good way to think about it? Not necessarily, because depreciation is a real expense. So that's one of the things we don't necessarily like about it as a proxy for free cash flow. but it's one that we happen to have fairly handy here. You actually can look at free cash flow, but I don't know that I have a best free cash flow metric, so I'm just going to skip this out. But you're going to see that actually if we take a look at it, this is now trailing, but you're going to notice that the enterprise value to free cash flow number is also basically near its all-time lows. Alternatively, we can take a look at it on a price to earnings basis. And what we can see is, has it ever traded as cheaply as it is right now? And this is price, again, the price to forward earnings estimates. So it's a historical chart of price to forward estimates. So the last data point that you have here, 10.84 or thereabouts, is the current multiple relative to the street's best guess for forward earnings. But we can track that through time and see how that looked through time. And what you can see is, were there periods when it was lower than it is now? There were, but they tended to be pretty rare. So as I'm looking at all of this, and I believe they're going to be reporting, if memory serves, is it next week? I knew that their earnings were coming up. Yes, next week. It's the 18th. Isn't the 18th Friday? That's not right. That doesn't seem right. Is that a pre-open? Okay, well, they're reporting next week. According to this, it's going to be Friday. It's either going to be Friday pre-open or it's going to be Thursday post-close. So I would look at it that way. We should actually probably go, now that I think about it, because that doesn't seem right. And as you know, sometimes these things aren't correct, so we should probably double check. So we'll do that. We'll just go quickly to Schlumberger's Investor Relations. And I should have noticed that when I was looking at it before, but let's see here. So, did they announce when the next one is coming out? When was the last one? We'll see what day of the week that was, because it's very likely to be the same. So that was on the 25th. Again, it's not that it matters a whole ton. Oh, it was on a Friday, okay. So it's probably Friday pre-open. So that's not out of step. Options market not implying a huge move, largely because it hasn't had huge moves in the past. But as we take a look at options premia in general, and so I'm just going to get rid of the realized number. Let's just take a look at the implieds. Okay. So we're still in the mid-30s over here. I think this is one of those situations, like there's two ways you could do this. You could start thinking about selling some cash covered puts to work your way into a position. Or this might be a good setup for a call spread risk reversal. Not a really big vol play to be had here, because I don't think there's going to be a huge vol crush, just because there's not a huge... So when we do things like strangle swaps or calendar spreads, we're usually doing those to take advantage of circumstances where we think that the backwardation in the volatility term structure is too steep. What I mean by that is that the near-term options have been jacked more than maybe they deserve to be in anticipation of event variance, in anticipation of an upcoming event. But in this case, as we just saw, the stock hasn't moved that much. It's not implying a move that big, so consequently the event variance is not that big, and therefore even if you tried to play for a vol crush, the amount that you can potentially make off of that is probably not going to be all that huge. So, you know, we should kind of almost look like, you know, we're going to sort of discount the event a little bit and not really think about it as a hugely big deal. But I'm taking a look at it simply because, and let me just pull this up one last time. I want you to take a closer look at this price chart. So one of the things you're going to notice is that although this thing has just been in this consistent downtrend, and all these other stocks have recovered off the Liberation Day lows in April. This one, you know, this is the April Liberation Day lows. This obviously hasn't bounced back to, you know, the pre-Liberation Day levels, but it has leveled off. It does sort of feel to me like it's sort of making an intermediate bottom, and we're supported a bit by the valuation. So cash covered put sales would be a potential way to play this. Call spread risk reversals might be a way to play this. I don't know that you need to go as far out as September. You know, we can try to focus on using expirations that are kind of close to that sweet spot, 6-7 weeks out, something along those lines. And you know, this probably go like a 30, go one. This is not what this is going to look like necessarily. And I'm saying that because this is going to be using aftermarket prices, so the bid asks are a little bit wide, as we just saw, but maybe like a 35, 39, and then you could space it out sort of equivalently on the put side, down a few bucks. So maybe 32s or the 31s, something like that. Get a trade kind of going like this. Now again, these prices aren't representative, so your own mileage may vary. Check the prices tomorrow. Stock was a little bit weak today, and I think, you know, sort of being a little bit contrarian for a near-term sort of support bounce kind of a situation might make some sense. And I will let other folks also opine on the technicals. Now that chart, if you're looking at the long-term trend, doesn't seem that hot, but actually when I was looking at a bunch of other indicators in it, so we'll just go to the backtest function here in Bloomberg, and we can take a look at some of the better performing technical indicators in Schlumberger. Now I was looking at this over the weekend, but as you can see, most of the better performing ones, including the commodity channel index, would be long here as well. So, you know, it's kind of a mixed bag, but it's mostly to the upside. So you have a technical setup that's generally pretty good. You have valuation setup that is historically quite good, and we've got earnings upcoming. So, and I also think, you know, we're living in a world that's maybe a little bit better for, you know, the legacy oil and energy companies. So yeah, we'll start with that. Now, because I got two questions on the topic, and I'm going to try to pull this, so you can see I'm using different, this one is a touch screen, so we're going to see if this works. So hopefully you guys are seeing that, because I can't actually see what you see here. But hopefully you have okay, so let me go. I'm being told to put it up again. So hopefully you all see the following question from Monday Morning Quarterback. Could you opine on the MicroStrategy preferreds? It seems to me they must keep raising money to pay the dividends or sell some Bitcoin, which they have vowed not to do. Also, how would you value the embedded call in STRK? Now, Finwest also asked a question on STRD. So let's talk about this a little bit. So MicroStrategy, and I'm just going to pull this up so you guys can see the different securities that were issued. Now the first bunch that were issued, so if you look over here on the right, I don't know how, someone else is going to have to tell me in my ear whether you guys can see this very well or not. I'm going to blow this up just a little bit. Hopefully I'm not taking it out. It's this section over here on the right that I want you to pay attention to. So all I was doing was looking up the related securities that the company has issued. So as most of you will know, the first thing the company did was issue these zero coupon convertible bonds. So zero coupon bond doesn't actually pay you a coupon, but all of whatever interest, if there was any, would be accumulated and then paid out on the back end, but they're convertible into the underlying stock. Now, as a mechanism to raise capital for MicroStrategy to purchase Bitcoin for their treasury reserve asset, that was pretty creative in my view. And effectively, what was going on there is that because there's a couple things that were going on all at once. The first is that there are asset interested investors. So for example, you might have fixed income investors who can buy a zero coupon bond, who might be ineligible for reasons of, you know, basically their investment strategy mandate, unable to buy something like Bitcoin, but felt like, hey, you know, Bitcoin is a very nice asset for a fixed income investor if you get into an inflationary world, right? So you have a hard currency asset that in theory should appreciate if the dollar is devalued, thus devaluing the net present value of your fixed income assets. Makes perfect sense. I'm not going to get too much into it right now because I don't happen to have those slides, but I modeled this out on an earlier live stream. Maybe someone can figure out while we're doing this which one it was. But one of the things that I identified was that if a high yield investor, for example, had owned just 150 basis points, 200 basis points in terms of their total assets, so like a 1 to 2% asset allocation to MicroStrategy zero coupon bonds, because those things did so well on the back of Bitcoin appreciation, they would have improved their total returns over the course of a year by about the amount of their allocation. So we're talking about 150, 200 basis points. In the world of fixed income investing, 150 basis point incremental total return is enormous, right? So that can take somebody who's in the bottom quartile of investment management and throw them all the way to the top. So a very attractive asset for that universe. So you have sort of a ready set of investors who might be interested in the asset class, who are otherwise unable to deploy capital there, who would therefore be interested in buying the zeros. Okay, so far so good. What else did I like about them? Well, two things. The first is that from Saylor's perspective, because Bitcoin is a volatile asset, the price that people would be willing to essentially buy these zeros at par in exchange for the convertible feature would be, would have a strike price that was considerably higher than the prevailing strike. Because an option, the higher the volatility, the more expensive the option is. So if the option is effectively the interest that the bondholder is getting, that's essentially how it works out, right? So the reason they're buying the bond is because they have this embedded optionality. That's essentially the compensation they receive for loaning the money. The higher the implied volatility, the farther away it could be. Now the net effect of this is that you can imagine, and you can do this yourself, that you could say, look, how about you give me $1 million, I buy $1 million worth of Bitcoin with it, and in exchange, I will pay you your $1 million back in 5 years, 10 years, doesn't really matter. And or you can convert the, I should not say and or you can convert, or the bonds will convert into stock in my business, which has the $1 million worth of Bitcoin, 50% higher than the prevailing cost of Bitcoin. Well, from Michael Saylor's perspective, this is pretty nice, right? Because he's borrowing money at no interest, and the MicroStrategy shareholders, this is accretive for them because effectively they then own the first 50% of upside in Bitcoin, right? The difference between the prevailing level and the strike of the convert. And the downside is that, of course, the zeros are senior in the cap structure, so in the event that Bitcoin falls, the bondholders will be repaid. They're entitled to whatever assets the company has in the event of a liquidation before. They're higher in the waterfall than the equity is. But of course, most of the people who are buying MicroStrategy stock, most of the people who are buying Bitcoin, they're not really looking down so much as they are up. So again, so far so good. One can understand the motivation for the people who buy it. One can understand the motivation for Michael Saylor to sell it. And one can understand why the shareholders of MicroStrategy might be okay with this arrangement. So high implied volatility, high convert strike, borrowing money at essentially no money, accretive to shareholders because you get the first piece of the appreciation. Synthetically, you're long a call spread. The issue with the preferreds, though, is that the preferred stock, and they have several of them, so I'm going to go back here, is that these things are paying a dividend, and if you pay a dividend, you have to have cash to pay the dividend. Where's that cash supposed to come from? Well, one way it has been described is that the cash to pay these dividends is going to come from the operating business of MicroStrategy. So MicroStrategy, before they were a big Bitcoin play, was a software company. The issue that you have, though, is that MicroStrategy as a software business isn't such a great do, right? So you're talking about a company that's got $460 million in revenues. And in order to, that's not going to generate a whole amount of excess cash to pay dividends. And this is one of the principal criticisms for those that have been critical of the preferreds. This is the principal criticism that they've had. They've said, I'm not sure I quite understand, we understand raising money to buy Bitcoin. That makes sense. If you believe in Bitcoin as an asset class, supported in part by a comment that Elon Musk made. So when he launched his new party, somebody then asked, do you believe in fiat currency? And then he said, or they asked if he believed in Bitcoin, and then he basically said fiat currency is doomed, and so therefore the answer is yes. Now, he hasn't been doing much for his own currency, Tesla shares, as he's gone through this whole process, but that's another matter. So the question then is, how do you satisfy the cash needs for paying the dividends on the preferreds if the underlying operating business isn't generating sufficient cash flow to do so? And that is the question, of course, that's being asked here. Do you just continue to sell more securities? And that is another way you could do it. They could issue more preferreds, they could issue more zeros, or they could, do things like this. So essentially continue to go back to the capital markets and return some cash in the form of dividends, and then using whatever is left over essentially to acquire more Bitcoin. But that is not, it's not a scheme that I like a whole lot. I definitely preferred, pardon the pun, I preferred the zeros to the preferreds as a mechanism for fundraising. The other thing that I rather liked about them is that if you have a perpetual preferred versus a zero with a specific maturity on it, it's just easier to model. So that's the, I'm not enamored of it. And by the way, look, you as investors have the opportunity, if you so choose, to sell vol on Bitcoin as an asset to help finance the purchase of more Bitcoin as well, if you choose to do so. You could buy IBIT, sell some upside calls, and use the incremental proceeds over time to fund the purchase of more IBIT and like that. Although I would also point out that the volatility of the asset is declining. So as a strategy, I'm not saying that it has an end date, because you can sell calls in Microsoft as well, which is only like 20 vol. But I'm just saying that the benefit over time might diminish if and as volatility compresses. Now, I should also add, we had Darkside on several weeks ago, and he and others who are in the space, one of the points that they have made about Bitcoin is that they actually believe that volatility is probably going to go in a sort of a wave, and we're going to sort of continue to see this as it matures. You see volatility drop, but then as a scarcity effect kicks in, you have the potential for a big spike in volatility. Now, I'm not going to say that's going to happen or it's not going to happen. I will say that that does happen in other assets. So, if you think about commodities that can get in very short supply, you will see that kind of a dynamic. So the volatility of electricity in periods of high demand is higher. The volatility of natural gas in periods of high demand and limited supply is higher. That is generally the case for most commodities. And it's one of the reasons that, unlike equities, it's not uncommon in those types of assets and commodities to see positive skewness. So instead of puts trading at a premium in implied volatility space to the upside calls, the opposite is true. And that is reflecting that pattern, that if you get into a scarcity mode, another example of a scarcity mode skew situation is when stocks go hard or impossible to borrow, like GameStop, right? You will again begin to see that skewness effect, and we do see it here. So that is something to think about. All right, James Forbin says, welcome to the East Coast from Southern Virginia. I'm imagining that it's at least as warm over there. Jay Bow says July 18th is indeed a Friday, so you are responding to Schlumberger's earnings. Bob is asking us now about Uber. Crossed its all-time high again today. Now what? Seems it's lately become inverse of Tesla, riding 95 and 100 August 15 calls, quarterly earnings released August 5th. Shall I take the profits now, hold, or roll up? Thanks. So the problem with Tesla today, it's not an inverse of Uber situation. It's an inverse of Trump situation. And that is that, Elon, it's never helpful for Tesla shareholders when Elon makes a public show of being opposed to the current administration. I saw an article earlier today that it jeopardizes Tesla's position in China if politicians in China think that Elon's relationship with the current administration is on the ebb. And that does make some sense, right? If you're thinking about how things work in a country like China, where obviously having government connections, everything is essentially done by the government and permitted by the government, then relationship with the highest leaders is absolutely critical. And so one can understand how, from their perspective, if he basically was, he and his son were working in the Oval Office one day side by side with Donald Trump, and they're hugging each other, and the next day they're saying they're out of their respective minds, that from China's perspective, they might be saying, okay, maybe Elon's not quite as important anymore. Is that true or not true? I mean, we probably have a different perspective here, but that kind of perception issue is important in a place like that, and China is important to Tesla. So I think the fact that Tesla is weakening here has a little to do with the ebbs and flows of his relationship with Trump, much more so probably than it does the ebbs and flows of Uber. That said, Uber's performance has been quite good. I think I've been generally pretty positive on the stock. I haven't done a strong buy on it, but when we've been talking about this in the past, and I'm okay. Let's see if we can get this thing to work here. Yeah, so we had that all-time high. When was that? May 20th. Yeah, and we're above that now. And just taking a look at the financials, we can see, so what do we got here? This, 5% free cash flow yield estimated for next year, which is about where we're at. That's solid. 15% top line growth, probably 15 to 20% estimated adjusted EPS growth, and trading less than 25 times that number. It's not like it's overpriced, so I don't mind staying long Uber here, despite the fact that it's had this strength. And again, I don't really think of it as a win-loss for Tesla as far as that goes. Hope that helps, and I'm sure probably your intuition is treating you much the same with respect to that. FinWest is saying the drawback to that yield is MicroStrategy is under no obligation to pay the dividend. That's true. So they have flexibility about how they can pay these dividends, and it's interesting that they described the fact that they were going to pay it, with the operating cash flows from the underpinning business. If you're a buyer of that, you would say, okay, well, do they have the capability to potentially generate cash flow from their operating business? I suppose. They haven't really illustrated that very effectively of late. Do they have the ability to raise additional capital in the capital markets? Clearly they do, so that's a benefit. And as far as Bitcoin is, that's a wholly transparent thing, but it's trading at a premium to the book value of its Bitcoin. So again, this is one of those situations where I fully get what Michael Saylor was trying to do when he issued some of these securities, and I also understand that there are investors who want exposure to the asset class, and this was a novel way for them to get it. And there was good reason for them to invest, and had they done so, and if they have, they've seen huge benefits for having done it. But that does not mean, so that can all be true, while it can also be true that if you are interested in Bitcoin, that you might be better off simply owning Bitcoin. Or you might be better off owning a more direct Bitcoin proxy, such as IBIT. Or you might be better off simply owning MicroStrategy and I would say selling some upside calls against it, and if that's too complicated, buying a product that does the same, like Misty, which we talked about at some length. And in fact, I'm actually going to be seeing, one of the reasons I'm on the East Coast is because I'm going to be seeing those people in New York Thursday and Friday. So I'm going to get together with the YieldMax folks. I think they're holding a bell ringing ceremony at the NASDAQ on, it's either Thursday or Friday. I'll be there for that, and then I'll be on Fast Money on the desk for the full hour thereafter. So for anybody who's interested, end of the week. And I actually should mention, now that I think about it, I'm glad I did mention that, because for those of you who tune in on Fridays for office hours with Mark Guttner, because I'm going to be in New York City at the NASDAQ, I'm not 100% sure whether we're going to be able to pull that off. We're going to see. Probably bring this kind of a setup, like a laptop and a couple other things, over to the NASDAQ market site, and we'll see if we can do office hours in that way, but there's a chance that it might be a little bit tough to pull off given everything else that's going on. So just mention that. Okay, what do we have here? So Pepsi has pulled back significantly from their all-time high 2 years ago. Is this a buying opportunity, or will changing health trends continue to weigh on the stock? Has a nice yield now, but limited growth. Well, yes, that's definitely true. I think that's true for a lot of staples, and that's definitely going to be the case here. You know, we can just take a look at what the trends actually are, and I don't know if you guys can see this. If somebody on production side can just let me know if I should expand this, or whether you guys are going to expand my screen. Okay, so a little bit harder for me to annotate on all these laptops as well, but if you can see my cursor here, this is really what I think you're talking about, Steve, which is that this thing is totally moribund. In fact, in real terms, it's not growing, it's shrinking. Because if you take a look at it, so full year for 2025, so their calendar and fiscal years line up. So no growth year on year. Last year, effectively no growth year on year. This coming year, 3%, which is on or about the level of inflation and economic growth. So we're treading water here. But in real terms, for 24 and 25, you're looking at shrinking numbers. And also on an adjusted EPS basis, you can see that actually the estimate right now for the full year is for a year-on-year decline of about 30 cents a share. Not huge, and still, respectable free cash flow. And that's really the most important thing. So when you talk about that dividend, this is the thing that you really want to look at, is, how are they doing on a free cash flow basis, and is the dividend well covered? And the short version to that is, it is. Right? So if this number for next year is true, that's really quite good, because that means that the company is, even net of all of those distributions, generating a free cash flow yield in excess of 5%. So I do like that. And let's use the conservative assumption set, and let's just say that things are a little bit worse, because it seems to be pricing it anyway, and that it's going to be trading, we'll call it, $7.5 a share this year and next. So that gets us to 17, 18 times. So it's not absolutely brutal. Let's see if it actually has traded much lower than that. I don't think. Let's see where can we find a time when it was trading lower? So it looks like the only times it really was trading at a lower turn was, so early 90s we were in a recession and we had some market weakness. We had the great financial crisis in 08. We had a swoon in 2011. It didn't trade this cheap even during the pandemic, although this was a staple, so I don't know that really is a staple, but it effectively trades like one. We're in that level, I think, where it's probably your downside risk is now fairly limited. Not all that surprising, given how the stock's been behaving, right? So it's trading considerably cheaper than it was. Let's see what that all-time high was. It's probably 21, 20. Oh, it's 23. I'm surprised. So where are we now? Yeah, this is a pretty big discount. This is kind of interesting too, if I just blow this up a little bit. Just take a look at this level where we are kind of bouncing around in here. This is actually not totally dissimilar to what we saw in Schlumberger, come to think of it. Right? So it would be really nice if this thing could break out. Has it gotten above the 150? Let's have a peek here. Let's see what we got. Not quite. Let's take a look at the other technical indicators and see what those have to say about it. That's generally pretty good. Yeah, so I mean, of those technical indicators over the course of the last year that have been working, more are bullish, including the top three here. Not that they've exactly knocked it out of the park. All of those, trading Pepsi, even with the best performing technical indicator over the last year, still underperformed the broad market, but you know. Let's see. Okay. Here's a good, I'm going to just bump ahead to this question because I've talked about this a lot and I think it's worth discussing. So PC is asking, could you explain a strategy for trading short 45 day to expiration 20 delta strangles as it hits either limits, rolling up or down, keeping the short strangle with newer limits? As it hits, so PC, I'm just going to ask you to follow up on that a little bit if I could. When you say as it hits limits, do you mean as it hits the strikes? So that could be an interesting, I'm assuming that's what you mean, but just elaborate on that. But the reason I wanted to touch on this is because it's something that I was giving some thought to last week actually. Yes, strikes. Okay, perfect. Yeah, so it occurred to me that, you know, stocks generally go up. On any given 30-day period, stocks are higher about 58% of the time, over like a 21, 22 trading day period. Stocks generally rise. And so one of the things that occurred to me and I don't think I've talked about it that much. Most of the individual trades that I discuss, you'll notice, have a long bias. You know, I'm rarely saying let's short this or short that because honestly, if things are overvalued, I have no idea when the rest of the market's going to figure that out. And you know, I've certainly seen things that are overvalued get much more overvalued. You know, I thought GameStop was grossly overvalued when the stock was taking off, and I thought it was grossly overvalued way before it got to the peaks that it did, but I never shorted it because I just don't play that game. It's a lot easier to take an investor's approach and say, okay, well, you know, in general, if I'm picking companies that are growing at least as fast as the economy, maybe a little bit faster, you know, I just have a time value of money. The best managed companies probably will do even better than that on a growth basis, so stocks are going to rise. And so when we talk about these short strangles, so we talk about them in a generic sense, but most of the strategies I usually talk are things like strangle swaps or upside call spreads or calendar spreads or diagonal spreads. In other words, the trades that I advocate are typically long delta. Delta 1, like 100 delta? No, but long delta. But when you talk about a 20 delta strangle, that's a delta neutral trade. And so I'm really glad you brought this up because let's just, we're already on Schlumberger, so what the heck, we'll use this as an example. A perfect example of a stock that I think, you know, what am I talking about? Selling downside puts, call spread risk reversals. Are these 100 delta? No. Are they long? Yes. Are they short vol? Yes. So if you're doing a short strangle, let's just compare a short 20, 45 day, let's see if we have something close to 45 days. So we're going to do a short call, we'll do a short put, and we'll pick 20 deltas on the call side. So that's going to be, well, we'll call it the 39, so those are 21 delta, close enough. And yeah, so we don't quite have a 20, this is not exactly delta neutral. Let's see if I can find. This would be pretty close to delta neutral. Now I want you to observe something here, which is that on this trade, there's a little bit more room to the upside than there is to the downside. But in truth, I wouldn't mind if, in general, particularly if you have technicals going your way, you've got fundamentals essentially going your way, you have the fact that the market generally rises going your way and you want to be short vol, I don't mind skewing these things slightly. So here, you're short a 14 delta call and you're short a 16 delta put. So maybe you could even say sell a, well, we're kind of caught in the middle here, but you could even go up this way. So shifting this to the right. I don't want to say skewing it to the right. I have heard other people describe it that way. They would say, oh, you know, I skew my strangles. You know, skew just means it's a little bit more one direction than the other. But for us, skew usually is referring to implied volatility of calls versus puts, and I don't necessarily want to conflate those two ideas. But let's just say I would prefer that people lean a little bit long delta. Now, how does that play into your question? Well, one of the reasons that plays into your question is because if part of your thesis is that you're comfortable owning the stock at that lower level, I might treat that very differently if the stock comes into my short put strike, because what I'm probably going to be inclined to do is just allow the stock to get put to me. If I'm getting a good rate of return on the short put. Right? So if it's a post-earning situation and implied volatility has been compressed and now it's like an 18 vol option, so you're not really getting a good rate of return. What's a good rate of return? It's an equity-like risk to be short options. What do we think a reasonable rate of return is? It's going to depend on how much leverage is on the company balance sheet, but let's just say that 12% is a decent annualized yield for equity-like risk, so it's going to have to be on the high side of that. And what that means is that when it comes to adjusting your options, if the rate of return annualized is getting down below 12% and then adjust for leverage, so if a more levered business, you want a higher rate of return, a less levered business, maybe it doesn't have to be quite so high. I might be more aggressive about adjusting it, right? So you want to adjust it based on the returns that it's likely to generate for you. But that does suggest that I'm probably going to be relatively tolerant of being put the stock. And then I can just sell calls against it, right? If I'm put the stock, I'll sell calls, and I'm essentially just doing the same thing again and again. Now, on the other hand, if it runs through my call strike, that's a different circumstance. And the reason is because I don't really like being short stocks. So where that is absolutely going to, where I would get triggered to do something is if the short call goes up to about 60 delta or more. I've talked about that before. If I'm short an option and it has now gotten to the point where that option has a better probability of being assigned than not, something about my initial thesis is off a bit. And so I'll usually look to evaluate it, and I'll probably adjust and roll at that point. Now, whether or not that yield constraint is going to trigger it then is not as much of an issue, right? So, because I don't want to be short stock, I don't want to be called out of it. That's not the objective. So, just a couple things about this. So you can shift the strikes a little bit higher, so you're leaning a little bit longer delta. It gives you a higher probability of being assigned on the downside and a lower probability of being assigned on the upside, but we've just described for a multitude of reasons why we might prefer that. And again, I'm going to much more aggressively adjust or cover the short strikes on the upside. I don't sell naked strangles that often, though. You know, more often than not, when I'm selling upside calls, I have a calendar or I have a diagonal on, and it's more often than not going to be around things like catalysts if it's on a single stock. And what I'm just talking about here, one additional caveat that I would just throw on all of this, which is that if you were selling strangles on an index, right? So the S&P, the Russell, the NASDAQ, the upside risk is more limited. That's not to say, but first of all, the implied volatility is going to be low, so you're not going to sell strikes that are that far out of the money. But the really big difference is that you're never going to get into a situation like a GameStop situation, where a stock becomes impossible to borrow and you get a short squeeze. You're never going to get into a situation where you're selling upside calls and it's a takeout situation. You know, Berkshire Hathaway is not going to come out and say, you know, we've decided that we're taking over the S&P at a 20% premium. But they can do that with individual equities. So that kind of shock element to the upside doesn't exist as much. So again, you can have a little bit more flexibility there. So if you have a cash settled index option and it drifts in and drifts out, but your rate of return is still decent, you know, so I guess what I'm saying is that don't treat every situation exactly the same way, but if it's a single stock and I go through my short strike, that I don't like, right? That's different than if it's on an index or something like that. And actually, to be honest, I mean, I've rarely found that on those low delta calls, it feels like, and I could be wrong on this, I should probably track it more carefully, but it feels like it rarely hits on the index side as much as it does on the single stock side. And the single stock side, again, because I'm usually covered by something else, but I've definitely noticed that. You know, you get these situations where a stock rallies 15% a month, and it seems to happen with, you know, surprising frequency. So anyway, hope that helps. Oh yes, somebody said, sorry about the audio, I'm on the road and working with limited microphone choices and fighting. Yeah, so we've got a lot of HVAC noises, ambient noises. We do actually have a lavalier microphone, but for some reason there was interference with the lavalier, so that was not working. We have a shotgun microphone located on the camera that we're using today, and because I'm traveling, you know, I flew to New York, then I was in Connecticut, then I was in New Hampshire, going to be in New York, then I'm going to Las Vegas. I just didn't want to travel with a whole lot of kit. I hope you guys can understand that. So unfortunately, we're just going to have to tolerate the limited functionality. Can't carry a TV studio with you everywhere you go. Okay. Yeah, so that was in response to Michael Walter about the sound poor. We might be able to figure that out if we can figure out why we were getting interference with the lavalier mic, because that obviously would work a whole lot better. But yeah, I appreciate your patience putting up with whatever it sounds like. I don't know exactly what it sounds like, but I believe you when I say it's not great. Okay. What do we have here? Let's see. Where did my Bloomberg go? Because I don't have an icon for it. What happened? Did I lose my Bloomberg? Oh no, that's strange. Okay. Okay, so Clover Health Investments, since earnings, company has had 4 different upgrades. That could be, oh, here we are. We're in another one of these penny stock situations. Yeah, this is in this small cap penny stock. I got to tell you, Michael Anthony, this is not a knock on your investment strategy at all, and I appreciate you tuning in and watching all the time. This is just not, it's not a space I really cover, right? So small cap companies, I just haven't dealt with them that much. Part of that was just because it was outside of our investment mandate for so long. So when I was running the 40 Act fund, when I was at the hedge fund also, we just couldn't trade these things. They just didn't have suitable liquidity, right? So we had a minimum investment side of 50 basis points at the hedge fund, which essentially meant that we had to buy a minimum of $25 million worth of stock, and usually a full-size position would be more than that. And it's just really difficult to, you know, purchase $50 million worth of a $1 billion company. You're buying 5% of the company, and actually then you have a whole new set of problems, right? Because then you actually have to file, and so it's outside of my purview. I apologize for that. Yeah. Oh, there was. Yeah, I think there was another one in here. Where was that? Oh yeah, here we are. Yeah, So same thing. So I can't, and unfortunately, there's a lot of securities out there, and I have to sort of say, okay, I'm going to pick a lane and try to understand that space. And I already am a generalist, right? So it's not like I only focus on energy. At one point, I only focused on energy stocks, and there were other times that I focused on other sectors. So I've covered a lot of different things in the industry, but admittedly, I just don't touch on the small cap companies that much. And that just has to do with, it was outside of our purview. It was not worth spending a whole lot of time looking at these things because we couldn't trade them. So there's only so many hours in the day, and I apologize for that, but I'm sure that there are people who do and can contribute, and it looks like Michael Anthony, like you do cover them in whatever capacity, and that's good. So and I always do find it helpful. I find it interesting to look at companies like this. So if you're looking at my screen right now, you can see this is a company that's growing the top line at a very nice pace by the looks of things. I don't even know what this company does exactly. Medicare Advantage health plans. Okay, so they're trying to compete with United Health and those guys, Humana. United Health has certainly been on its heels a little bit lately. Here's one thing I would quickly point out, that if the Street's forecast for their operating results, so if these things are true, I have no opinion on whether they are or are not, but let's just say that somebody said, okay, I'm going to show you some financials for a company. This is actually probably a worthwhile exercise to talk about. I'm willing to look at any company's financial statements and say, does this appear to be doing what widgets they sell, what service they provide? Let's leave that on the side, but just take a look at their operating results over time and their anticipated operating results over the next couple of years and the multiple that you have to pay to get that. And then secondarily, just think about whatever business it is. Maybe they're a drug dealer, who the heck knows what they do. But, what do the financials look like? Well, this is a company that's expected to grow their top line at 36% year over year and more than 20% next year. Those are good numbers. It is not making money yet. It's not profitable, but cash is king. And the Street seems to think that this company is going to generate about $137 million in free cash flow full year 2026. Well, $136 million in free cash flow for a business that has an enterprise value of less than $1.3 billion means that its free cash flow generation is more than 10% of the enterprise value of the business. And it has $195 million in cash on the balance sheet. So you put those two things together and I would say, okay, you've piqued my interest. If I was going out and I was a private equity guy, and we used to take a private equity approach at Ivory, that was how we would think about businesses, exactly this kind of a situation. Is the company going to be generating free cash flow sufficient to satisfy their debt and pay something out to the investors? And if these numbers hold up, then the truth is that it's a more compelling valuation than the S&P then, isn't it? Who wouldn't rather have a business that has a 10% free cash flow yield and is growing the top line at 22% a year? Sounds pretty good, But the truth is I don't know their business because I haven't been following them, so I can't really speak to that. But I do think that it's a worthwhile exercise, and whatever work you're doing to help yourself identify these companies, good on you. So you just asked whether it's good for a company to be added to an index, and the short version to that is yes. The short version is yes. But getting added to the Russell 3000 or even to the Russell 2000. So the Russell 2000 are the small cap names. Russell 1000 is sort of the Russell's bigger variant of the S&P 500. One of the real benefits of being added to an index like the NASDAQ Composite or the 100 or the S&P 500 is that it spurs a whole lot of passive investing into that, because everybody has to own it. If you're tracking the S&P 500, if that's your benchmark, there are a lot of closet indexers. That's the first part. The second thing is there's a lot of index funds. Vanguard S&P 500 fund, SPY. You have all of these products that track it. And what that means is that they're going to get pro rata investment for every incremental dollar that flows into that index and the passive investments that surround it. So is it a positive to be added to an index? Yes. Is it a negative to be withdrawn from an index? Yes. So it is a positive. But the problem is that there's less money tracking the Russell 3000 than there is the S&P 500, than there is the Russell 1000. And actually, interestingly, if it's in the Russell 3000, then it's in the Russell 2000. And the Russell 2000 is, so a lot of institutional money cares a lot about the Russell 2000, and there's not that many really good Russell 2000 managers. So, if you're, I encourage all of you to poke around in this area. I probably should spend more time in it myself than I do. But again, I only have so many hours in the day. But yeah, it is a positive. So again, all good. Netflix is reporting next week. Still room for another upside move. I've called them basically an unregulated utility, and it's tough for me to keep saying it because the higher this thing goes, you keep holding your breath when these things come out. But I mean, it's such a great business that they're in. I mean, double-digit top line, comfortable double-digit bottom line. The same thing we were just talking about, which is, good free cash flow growth. It's not the same kind of free cash flow yield, that we're talking about here. So, we're getting into a much testier kind of valuation. I'm a little bit more anxious about that, I have to say. But I don't think there's anything fundamentally wrong with their business. Quite the contrary. It's just that now we're getting to 50 times free cash flow. So free cash flow is 2% yield. Compare that with what we were just talking about, 10% versus 2%. Comparable top line growth. So that's one of the benefits of kicking the tires in some of those small cap companies. If people aren't chasing it. The other thing is that the bigger a company gets in a cap weighted index, the more passive money flows into it, and the more that can support the valuation. The same thing can work in reverse. So if the market's generally doing well, that's also going to support the mega cap equities, right? Money's just naturally flowing in. It's going to flow into those more than it flows into others. But the valuations on all of these top high level names are all getting a little bit worrisome to me, and that and that includes Netflix, as good a business as I think it is. I guess that's kind of talking out of both sides of my mouth, but if you have I'll put it into perspective. It's the biggest holding of my former boss, and ahead of the last earnings, which we talked about at length because you'll remember that came right before a Friday holiday, and so we had an unusual circumstance where they were going to be reporting earnings on an expiration day because they were reporting on a Thursday after the close, which also happened to correspond to a holiday because of Good Friday. So we were talking about it, and I had conversations, as I often do, with my former colleague, still a good friend of mine, and he said he was going to add to his position. I asked him if he wanted to try to hedge it, and one of the reasons he didn't really want to hedge it was because he has a $200 basis in the stock. And he lives in California, so he has a huge potential tax liability. Stock, to justify selling it, if you have a long-term hold in something like this and you live in a high tax area, again, I'm not offering tax advice, but I can fully appreciate that if you're in that circumstance, it's a really difficult thing to start taking profits at a time like this, because think about how much that stock has to pull back to offset the tax hit you're going to take from selling it. If you have a $200 basis, that means you have a $1,000 gain. And in a state like California, where they don't really distinguish capital gains at all, it's all considered income, and you're in that top tax bracket, as my friend is, I mean, that means that he's paying $150 a share just to the state of California. So he's saying, what's going to happen out of earnings? The stock's going to pull back 10%? Between his federal and state tax liabilities, even if he thought it was going to fall 10%, he wouldn't sell it. It would have to fall, you'd have to think that the stock was going to have like a 25 or a 30% washout before you'd even think about it. So, anyway, again, this is going to be dependent on each, whoa, we've chewed up the hour already. an hour of you guys, for those of you who stuck around, I really appreciate it because I realize the audio is not working great. Hopefully we'll get this sorted out and it'll be a little bit better on Wednesday. If you have any additional questions, things you want to look at, drop them into the comments section, not into this little chat, but into the comments for this video, because then I don't actually see these after we go off, but then I'll have time to take a look at some of these things. So, you know, if you have a situation where it's, you know, if it's $1 billion company, honestly, I'm probably not going to have that much time to look at it. But if it's something that is in the Russell 1000, you know, or it's a more general sort of academic and educational type of question, drop it in the comment section. Like, subscribe, and all that kind of good stuff. And, you know, I apologize I can't answer every question. Number one, because I don't have every answer. Some of the answers I have are not going to be right in any case. But, you know, I have... it's not total blinders on, but I only look at a relatively narrow universe. So I hope that helps you. Thank you for joining, and we'll see you on Wednesday, 4:15 Eastern. Thanks for watching.